Welcome to the Bullion Signal Podcast, where we look beyond the daily noise to understand the powerful undercurrents shaping our financial world, especially when it comes to gold, silver, and the preservation of your wealth. Today, we're diving into a fascinating and frankly chilling analysis. It's a hypothetical scenario, but one that's built on very real-world pressures. Imagine a crisis that doesn't start with a loud market crash or sirens wailing on the news. Instead, it begins silently with a simple bureaucratic memo, a quiet halt to the financial machine while the world isn't watching. We're going to walk through a story, a financial thriller of sorts, that imagines a moment when the promises of the paper silver market collide head-on with physical reality. The source material calls it the Christmas Eve lockdown. If you find this kind of deep dive analysis valuable for protecting your future, make sure you're subscribed to Bullion Signal Podcast so you never miss an episode.
This quote right here, it perfectly captures the heart of the scenario we're exploring today. When an asset's price suddenly breaks free from the very system that was designed to contain it, it's easy to mistake that for a celebration, a victory. But the author of this analysis argues it's exactly the opposite. It's a warning sign that the system itself, the trust that held it all together, has fundamentally failed. It signals the death of faith in paper promises and the beginning of a desperate, frantic scramble for something real, something tangible. So let's explore exactly how that failure could unfold.
All right, so let's get into the specifics of this narrative. It all begins on what should be one of the quietest trading days of the entire year. The world is winding down for the holidays, minds are elsewhere, but behind the scenes, a critical gear in the global financial machine just seizes. This isn't a slow, grinding decline that people can see coming for months. It's a sudden, calculated stop. It's a strategic move made under the perfect cover of public celebration and distraction. And the goal isn't to fix the underlying problem, not at all. It's simply to stop the bleeding and buy a few precious days of time. So first, let's look at the main event itself, the lockdown. How could a global market for a critical commodity be frozen right in plain sight without causing an immediate worldwide panic? Well, according to this analysis, the key isn't a dramatic emergency announcement. No, it's something much more subtle. It's a quiet, almost mundane, bureaucratic maneuver. Here's the sequence of events as the scenario lays it out. On Friday, December 20th, a presidential executive order is issued. Now, it's not framed as an emergency declaration. It's presented as a gift, a gesture of goodwill. It declares Tuesday, December 24th, and Thursday, December 26th as new federal holidays. With Christmas Day on Wednesday, this simple act creates a 4-day market shutdown. Now you might ask, why does that matter so much? Well, because it effectively freezes the COMEX delivery system, the main hub for metals trading in the United States. No physical silver can be moved out of their vaults. No deliveries can be fulfilled until the markets are scheduled to reopen on Monday, the 29th. It's a hard stop. And this is where we see the two faces of this action. Publicly, the justification is simple and heartwarming, giving federal employees a longer holiday to be with their families. It's a feel-good story for the evening news. But the analysis points to a far more desperate and hidden motive. The real reason for this unprecedented holiday, it argues, wasn't about giving workers more family time. It was about giving the exchange itself a lifeline. It was a desperate move to halt the relentless draining of physical silver from the COMEX vaults, a drain so severe that it was threatening a complete and catastrophic default on their delivery promises.
You see, this lockdown wouldn't be some random decision. According to the source, it's a direct emergency response to something historic that's happening in the silver market. Think of it as a bank run, but this time it's not on a bank. It's a run on the very vaults that are supposed to guarantee the value and stability of the global silver price.
Just look at these numbers. They really tell the story better than I ever could. In a typical, normal month, the COMEX might see delivery requests for somewhere between 5 and 10 million ounces of physical silver. But in this scenario, in the first 4 trading days of December 2025, a tidal wave hits. Traders demand physical delivery on a staggering 47.6 million ounces. Let that sink in. That's about half a year's worth of normal activity, all compressed into less than a single week. This isn't just speculation anymore. This represents a profound systemic loss of faith in the paper contract. This is the big money, the serious players all saying the same thing at once. I don't want your promise anymore. I want the metal, and I want it now. Now, to really understand why this is a crisis, you have to understand this absolutely crucial distinction. COMEX vaults hold 2 different categories of silver. Most of the inventory is called eligible. The best way to think about eligible silver is that it's just being stored there, like in a safety deposit box. It's privately owned, and the exchange has no right to touch it. The only silver that actually matters for settling contracts is registered silver. That is the metal the exchange has on its books, ready to be paid out. And as you can imagine, that number is much, much smaller.
This is the number that allegedly forces the government's hand. After that massive run in early December, and after accounting for all the delivery notices that were already filed for the end of the month, the analysis claims that the COMEX would have been left with just 64 million ounces of registered silver. I want you to really think about that. The entire global paper market, a market trading billions and billions of notional ounces of silver, would be backstopped by a physical stockpile so small it could probably fit into just a handful of Olympic swimming pools. This isn't a buffer anymore, it's a rounding error. The system was on the verge of being exposed for what it is, a fractional reserve system with almost no reserves left.
So why? Why did this run happen in the first place? It wasn't just some sudden irrational panic. No. The source argues that this vault run was simply the final explosive symptom of a much deeper long-term disease, a structural crisis in the physical silver supply that has been quietly building for nearly a decade. For 7 straight years leading up to this hypothetical event, the world has been in a documented silver deficit. Now, what that means is very simple. Every single year, global demand from industry, from investors, from jewelry, has been higher than the total global supply from mining and recycling. According to the source, that cumulative shortfall has reached a staggering 1.2 billion ounces. That's more than an entire year of global mine production that has simply vanished from all the world's known above-ground stockpiles. For years, we've been filling that gap by emptying out the world's drawers, so to speak. But in 2025, the scenario says the drawers are finally empty. And this chart shows you exactly where all that silver is going. It's not just about coins and bars for investors. Silver is a critical, and in many cases, irreplaceable component in the world's most important and fastest growing industries. Every solar panel you see, every electric vehicle on the road, every massive AI data center being built, every 5G tower, they all require physical silver to function. This isn't speculative demand that you can just regulate away with a new rule. This is inelastic, hardcore industrial demand. You literally cannot build a green energy future or an AI-powered economy without it. And all of these crucial industries are demanding more and more silver every single year.
And then you have to layer on top of all that industrial demand a powerful geopolitical shift. Nations themselves are starting to treat silver as a strategic asset, not just a financial one. In this scenario, the U.S. has already designated it a critical mineral. China, to protect its own industries, implements a ban on silver exports. And you have broader trends like the BRICS nations actively shifting their reserves away from paper currencies and into hard commodities. When governments start stockpiling a resource, it's one of the clearest signals you can get. It signals a deep loss of faith in the global paper currency system. Now, for those of you who have followed the markets for a long time, the idea of a major crisis in the silver market might sound a little familiar. And to really grasp what makes the 2025 scenario so different,
so much more dangerous. The analysis draws a crucial comparison to the most famous silver event in modern history, the saga of Silver Thursday. So, way back in 1980, two Texas billionaires, the Hunt brothers, attempted to corner the silver market. They bought up massive amounts of silver futures contracts, and crucially, they demanded physical delivery of the metal. Their actions sent the price skyrocketing from around $6 to nearly $50 an ounce. But the exchange fought back. They simply changed the rules in the middle of the game. They implemented something called Silver Rule 7, which basically banned any new buying of contracts. This broke the back of the rally, forced the Hunts to sell, and triggered the infamous Silver Thursday price collapse. In the end, the paper market won. But this right here is the critical distinction that the source makes, and you absolutely need to understand this. The 1980 crisis was an artificial crisis. It was driven by a couple of speculators using borrowed money. They were trying to create a scarcity that didn't really exist. The 2025 scenario is the complete opposite. It describes a crisis driven by a real, fundamental, physical scarcity. It's not a handful of traders making a bet. It's the bedrock industries of the entire global economy and sovereign nations all demanding the physical metal at the exact same time. Here's the bottom line. You can change the rules to stop a few speculators, but you cannot change the rules of physics to stop a real shortage. So all of this brings us to the moment of truth. The market is frozen. The vaults are on the brink of being empty. The entire world is waiting. What happens when the holidays finally end and the machine is switched back on? The narrative outlines three potential paths forward, three possible futures. So what happens next? The analysis lays out three possibilities. The first and most dramatic is force majeure. That's a fancy term for a default. The exchange simply declares that it cannot deliver the physical metal that it promised. All outstanding contracts are forcibly settled in cash at some arbitrary price. At that moment, the paper price you see on TV becomes meaningless. The real price of silver would then be discovered in physical markets around the world, likely at a much, much higher level. The second option is the kick the can scenario. Regulators and banks put immense pressure on the big players to just roll their contracts forward, basically delaying their demand for physical silver to a future month, hoping the problem goes away. This solves absolutely nothing, but it keeps the illusion alive just a little bit longer. And third, you have the black swan, a completely unexpected event, a massive new mining discovery, a new technology that replaces silver, a sudden global depression that crushes demand, something that fundamentally changes the entire equation. But given the powerful long-term trends we've discussed, this seems like the least likely outcome. The ultimate takeaway from this entire hypothetical analysis is this. It represents a historic turning point. For the last 50 years, the price of silver has largely been determined by the trading of paper contracts, with only a tiny, tiny fraction of those contracts ever being settled with physical metal. And the system worked, as long as everyone played along with the game and trusted the promise. But the Christmas Eve lockdown scenario describes the moment the game finally ends. It's the moment the physical market, driven by undeniable real-world demand, finally calls the paper market's bluff. It's the moment of realization that there simply is not enough real metal to back the mountain of paper promises that have been built on top of it. And this leaves us with the final and most profound question at the very heart of this scenario. If the price you see on a screen can no longer be exchanged for the actual thing it's supposed to represent, what does that price truly mean? This isn't just about silver, it's about the very nature of money, price, and value itself in our modern financial system. The key takeaway here is not to predict a specific date on a calendar, but to understand the growing, undeniable tension between finite physical things and infinite digital promises. As you consider this information, and please remember, this is for educational purposes only and is not financial advice, the real question to ask yourself is this. When a crisis hits, what would you rather hold? A promise on a screen
or the real thing in your hand. Thank you for joining me on the Bullion Signal Podcast. Please do your own research and always think critically. We'll talk again soon.